Hello everyone. Today I want to talk to you about a truth that most traders spend years trying to understand. It's simple, but it's uncomfortable. One trading strategy can make money for years. Not 10 strategies. Not a new indicator every month. Not the latest system from social media, just one. But here's the catch, it's not the strategy that makes the money. It's the psychology behind the person trading it. Most traders don't fail because their strategy stops working. They fail because they stop working the strategy. They abandon it at the first drawdown. They doubt it after 3 losses. They tweak it after a small losing streak. And every time they do that, they reset their learning curve back to 0. Let me explain something clearly. Every real trading edge has losing trades. Every profitable system has drawdowns. That's not a flaw, that's the structure of probability. If you don't accept that, you'll never stick with anything long enough to see its power. Think about this. A casino runs one simple system. The rules don't change every week. They don't panic when someone wins a few hands. They don't redesign blackjack after a bad night. They understand their edge works over time. They understand probability, and they trust the process. Traders don't. A trader has 3 losses in a row and suddenly the system is broken. They start searching YouTube. They buy another course. They add 3 more indicators. They remove 2. They switch time frames. And in the process, they destroy the only thing that creates long-term profit: consistency. One strategy can make money for years if it has a real statistical edge, but that edge only shows up when you execute it with discipline over large sample size. Not 5 trades. Not 10 trades. Hundreds. The problem isn't strategy failure. It's emotional instability. Let me tell you about a trader I once worked with. He had a simple trend following system. It worked beautifully in backtesting. It worked in forward testing. Over 200 trades, it showed a clear profit curve. But in live trading, he couldn't follow it. Why? Because trend following has small losses and occasional big wins. He couldn't emotionally tolerate the small losses. After 4 or 5 in a row, he would hesitate on the next trade. And that next trade was often the big winner. He would miss it. Then he'd feel regret. Then he'd jump in late. Then he'd lose. The strategy didn't fail, his psychology did. Here's the truth most people don't want to hear. If you can't follow one strategy for a full year without changing it, you don't have a strategy problem. You have a mindset problem. A real edge is boring. It's repetitive. It feels almost mechanical. There's no constant excitement. There's no daily reinvention. It's the same setup, the same rules, the same risk management over and over again. And that's why it works. Consistency creates clarity. Clarity builds confidence. Confidence reinforces discipline. Discipline protects the edge. But let's go deeper. Why does one strategy work for years? Because markets move in repeating behaviors. Human psychology doesn't change. Fear and greed don't disappear. Supply and demand don't vanish. Volatility expands and contracts in cycles. Trends form, ranges form, breakouts happen, pullbacks happen. If your strategy is built around a fundamental market behavior, not a temporary trick, it can last for decades. Trend following has worked for decades. Mean reversion has worked for decades. Breakout trading has worked for decades. The structure may slightly adapt. Risk parameters may evolve. But the core principle remains. What destroys longevity isn't the market. It's the trader's inability to sit through discomfort. Here's another psychological truth. When traders experience a losing streak, they feel personal failure. They think, maybe I'm not good enough. That emotion pushes them to change strategies in search of relief. Not improvement, relief. But relief is expensive. Every time you reset, you lose data. You lose screen time experience. You lose pattern recognition. You lose confidence in execution. The traders who make money for years understand something powerful. Losses are business expenses, not identity statements. If your strategy has a 55% win rate with proper risk reward, you already have an edge. But that means 45% of the time you will lose. If you can't emotionally handle that 45%, you will sabotage the 55%. Let's talk about discipline. Discipline is not forcing yourself to trade. Discipline is following predefined rules without emotional negotiation. It means taking the trade when your setup appears, even if the last 3 lost. It means not taking trades when your setup is absent, even if you feel bored. One strategy only works long-term when execution is stable. Now I want you to imagine something. Imagine you commit to one clean, simple strategy. You backtest it. You forward test it. You understand its win rate, its drawdowns, its behavior in different market conditions. Then you promise yourself, I will execute this for 12 months without changing the rules. What happens? At first, it's uncomfortable. You want to tweak it. You'll question it. You'll compare it to others. But over time, something changes. You begin to understand its personality. You recognize when it performs best. You understand when to reduce risk. You develop pattern memory. That's when the edge compounds. Most traders never reach that stage because they switch before mastery develops. Mastery doesn't come from strategy hopping. It comes from depth, not variety. Another important truth, the simpler the strategy, the longer it tends to last. Complex systems with too many filters often break when conditions slightly change. Simple strategies based on core market principles adapt more naturally. But simplicity requires emotional strength, because simple systems don't give you constant reassurance. They give you clear signals and expect you to trust them. Trust in your strategy comes from data. Confidence comes from repetition. Stability comes from emotional control. Let's address fear of market change. Yes, markets evolve, volatility shifts, economic cycles rotate, but core behaviors repeat. A well-structured strategy with proper risk management can survive different environments because it's built around probability, not prediction. Prediction is fragile. Probability is durable. The traders who make money for years don't predict every move. They manage risk and let probabilities play out over time. There's a psychological shift that happens when you truly commit to one strategy. You stop chasing perfection. You stop trying to catch every move. You stop comparing yourself constantly. You focus inward. You refine execution. That shift alone improves results dramatically. Because trading success isn't about finding the holy grail. It's about becoming the kind of person who can execute a good system consistently. Let me leave you with this. If you want a strategy to last for years, you need 3 things. First, a real statistical edge tested over a large sample size. Second, strict risk management that protects you during drawdowns. Third, psychological stability that allows you to follow the plan without emotional interference. Remove any one of those and the system collapses. But when all 3 align, something powerful happens. Results smooth out. Confidence increases, emotional swings reduce. Trading becomes less dramatic and more professional. One strategy, executed well, over time. That's the truth most traders avoid because it sounds too simple. But simple doesn't mean easy. It requires patience, emotional maturity, self-awareness. The market rewards consistency, not creativity. If you truly want to make money for years, stop searching, start committing. Stop tweaking, start executing. Stop doubting after 3 losses. Start thinking in hundreds of trades. Your strategy doesn't need to be perfect. Your psychology does need to be stable. Master that, and one strategy can carry you for years. I want to talk about something that quietly destroys more traders than bad risk management, more than low capital, and more than market volatility. It's the addiction to switching strategies. Most traders believe they are searching for the right system. What they're actually doing is running away from discomfort. And that behavior alone prevents one strategy from ever making money for years. Let me explain something clearly. A profitable trading strategy does not feel good all the time. It does not win every week. It does not avoid drawdowns. It does not protect your ego. And because of that, most traders never stay with one long enough to experience its real power. Here's what usually happens. A trader finds a strategy. It makes sense. They backtest it for a few weeks. They see potential. They feel excited. They start trading it live. Then the market shifts slightly. They take 3 losses in a row. Doubt creeps in. Maybe this doesn't work anymore. Maybe I entered wrong. Maybe I need another filter. Maybe I need confirmation from another indicator. Within days, they are adjusting rules. Within weeks, they are studying something new. Within months, they have tried 5 different systems. Now here's the psychological truth. The problem wasn't the strategy. The problem was the trader's intolerance for uncertainty and normal statistical variance. Every edge has losing streaks built into it. If your strategy has a 55% win rate, losing 5 trades in a row is mathematically possible. Not common, but possible. But when it happens, most traders interpret it emotionally instead of statistically. They feel betrayed by the system. They feel foolish. They feel fear. And fear demands relief. Switching strategies gives temporary relief. It feels productive. It feels proactive. It feels like progress. But it resets mastery to 0. Let me give you a simple analogy. Imagine trying to become a professional pianist. You practice for 2 weeks. It's hard. Your fingers hurt. You make mistakes. Instead of continuing, you decide maybe guitar is better. You switch. 2 weeks later, same frustration. Now you try drums. Years pass. You never master anything. That's what strategy hopping does to traders. Depth requires repetition. Repetition requires patience. Patience requires emotional stability. Without emotional stability, no strategy survives long enough to compound. Now let's talk about probability. Trading is not about being right on the next trade. It's about having an edge that plays out over a large series of trades. Think like a casino. A casino doesn't panic after a bad night. They don't redesign roulette because a player got lucky. They understand that over thousands of plays, the house edge asserts itself. Professional traders think the same way. Retail traders think in small samples. 5 trades feel like proof. 10 trades feel like confirmation. 3 losses feel like disaster. But small samples lie. One strategy can make money for years only if you allow it to operate across hundreds of executions. And here's where psychology becomes everything. Losses feel personal. Even if you intellectually understand probability, emotionally you still want immediate validation. You want proof that you're smart, proof that you're capable, proof that this works. But the market does not reward emotional needs. It rewards statistical consistency. Let's go deeper. When traders switch strategies repeatedly, they never build what I call behavioral familiarity. Every strategy has rhythm. Trend strategies behave differently than mean reversion strategies. Breakout systems behave differently than pullback systems. Scalping behaves differently than swing trading. When you stay with one long enough, you begin to sense its flow. You understand when conditions favor it. You recognize when volatility supports it. You learn how it behaves during drawdowns. That understanding doesn't come from theory. It comes from screen time with the same rules. Without that familiarity, every trade feels uncertain, and uncertainty triggers emotional interference. Now here's the hidden cost of strategy hopping, confidence erosion. Every time you abandon a system, you send your brain a message, I don't trust my decisions. Over time, that creates hesitation. Even when you finally find a solid edge, you won't execute it fully because your identity has been shaped by inconsistency. Confidence in trading does not come from winning. It comes from disciplined repetition. You gain confidence when you say, this is my system. I know its numbers. I know its risk, I know its drawdowns, and I will follow it. That stability compounds over years. Let's address another psychological factor, boredom. One strategy executed properly is repetitive. Same setups, same confirmation, same risk parameters. For many traders, that feels boring. And boredom is uncomfortable, so they look for novelty. But novelty is expensive. Every new strategy requires testing, adjustment, emotional adaptation. And data collection, you never reach the stage where the edge compounds because you constantly restart the process. Now let's talk about long-term money. Compounding requires consistency. Consistency requires stable rules. Stable rules require emotional control. If your rules change every month, your equity curve will reflect chaos. If your rules stay stable for years, your equity curve can smooth out. Longevity in trading is built on psychological endurance. Not brilliance, not constant innovation, endurance. The traders who survive for decades are not constantly reinventing themselves, they refine. They adjust slightly. But their core edge remains intact. They don't chase every market phase. They understand that no strategy performs best in all conditions. They accept slow periods. They reduce risk during unfavorable conditions. But they do not abandon their foundation. And that is the difference. One strategy can make money for years because markets are driven by